Broad markets flushed red in the latest session with indices sliding hard. Yet energy surged over 2% to completely decouple from the tech slump. The VanEck Semiconductor ETF dropped 4.8%. Its moat scores none out of 100, data not available. While sentiment pulled back, hyperscalers are deploying over $100 billion in capital expenditure toward physical hardware infrastructure. This enterprise artificial intelligence surge drives a modern gold rush for silicon. Our teardown reveals how hardware delivery bottlenecks impact fundamental ETF performance. VanEck Semiconductor ETF dropped 4.79% to $504.22 as Wall Street forces an abrupt AI capex reset. That swift single-day decline pushed the fund's relative strength index down to an oversold 24.2. Yet, even with this concentrated selling, the ETF maintains a massive 82.3% year-to-date gain. At the lab, we look past surface narrative to inspect structural fund architecture. Short-term technical trends remain clearly bearish as the 20-day moving average crosses below the 50-day moving average. This downturn is driven by hyper-concentrated weightings at the top of the fund. Top constituent NVIDIA at 17.8% weight absorbs the direct shock of tightening enterprise compute budgets. Second largest, holding Taiwan Semiconductor Manufacturing Company sits at 9.2% weight. TSM faces immediate utilization friction as hyperscalers slow advanced node commitments to preserve capital discipline. Micron Technology represents 5.8% of the fund. Micron faces near-term pricing headwinds from aggressive high-bandwidth memory build-outs meeting slower buyer commitments. While mainstream media labels this a simple tech pullback, our analysis reveals a systemic hardware reevaluation. Capital discipline demands are hitting compute, foundry, and memory layers all at once. Because these three holdings control nearly one-third of net asset value, single-stock stress cascades through the portfolio. The fund's heavy concentration amplifies hardware cyclicality, leaving investors vulnerable to sudden institutional capital shifts. Open the hood on the VanEck Semiconductor ETF. The largest single dragging, CLAC at minus 10.8%, carrying 5.3% of the fund. The marketing promise of broad semiconductor diversification is a complete financial illusion. VanEck's SMH concentrates 43.9% of its total net asset value into just 5 holdings. NVIDIA commands 17.8% of NAV. TSMC holds 9.2%. Micron sits at 5.8%. Applied Materials takes 5.7%, and AMD secures 5.4%. Wall Street packages this vehicle as a balanced sector fund. The lab analyzes it as a precision-engineered AI hardware stack. NVIDIA designs the primary AI architecture. TSMC fabricates the physical silicon. Micron supplies high-bandwidth memory. Applied Materials provides the advanced equipment required to build these foundries. This explicit holding composition explains the fund's recent performance edge over peers. Over the last month, SMH beat direct benchmark peer SOXX by 4.3 percentage points. It also surged past equal-weighted peer SCHD by 4.8 percentage points in that same window. While official fund filings omit expense ratios and total AUM figures, return metrics expose the operational truth. A massive YTD gain of 82.3% significantly accelerates past its 3-year average return of 49.5%. Equal-weighted chip funds suffer because legacy analog manufacturers dilute overall sector growth. SMH bypasses legacy drag by routing capital directly into the physical bottlenecks of advanced compute. Fund managers advertise broad diversification to comfort retail investors. This holding structure discards legacy noise to maximize capital velocity toward high-margin hardware leaders. SMH is an engineered compute monopoly vehicle that trades diversification for maximum silicon pricing power. SMH is trading at a 4.7% discount to NAV, while the 5-day volume is 1.54 times the 20-day average. That's not just strong inflow. It's institutional capital flooding in while retail sentiment is still lagging. The discount tells us the market narrative hasn't caught up to the actual money flow. Retail is selling the story. Institutions are buying the hardware. RSI at 24.2 and price below both the 20-day and 50-day moving averages? That's textbook oversold momentum. But momentum is a trailing indicator. The real signal is the volume spike. Capital isn't waiting for confirmation. It's positioning ahead of the next AI hardware cycle, not reacting to tariff headlines. The macro narrative is screaming Trump trade reversal, but the lab sees the disconnect. Tariffs are noise. The actual growth driver is the 12 nanometers bit serial CNN accelerator in the AR14 paper. That's the hardware enabling always-on XR perception under 2-watt power budgets. The fund's YTD return is 82%, but the 3-year average is 49%. That's not a Trump trade. It's a structural hardware rotation from software modes to silicon supply chains. VanEck's narrative calls this technology exposure. The lab calls it a semiconductor engineering ETF with 68% of its weight in the 3 companies building the next generation of AI inference chips. The discount is temporary. The inflow is structural. The narrative will catch up. The enterprise artificial intelligence surge acts as a modern gold rush for physical hardware infrastructure. The VanEck Semiconductor ETF supplies the indispensable physical pickaxes required to build digital brains. Year to date, SMH has gained 82.3%, easily outperforming the broader Nasdaq benchmark. The fund structure maintains reasonable diversification across holdings while concentrating capital in key sector leaders. However, external macro catalysts present real operational risks to this structural thesis. Strict U.S. export limits on high-end chips to China directly slash revenue for top holdings like NVIDIA and ASML. Simultaneously, high Federal Reserve interest rates make building new chip factories significantly more expensive. The lab monitors 2 primary operating signals to evaluate long-term structural durability. First, we track market share shifts as rising competition from AMD challenges NVIDIA's dominant hardware position. Second, we monitor geopolitical tensions around Taiwan, which threaten TSMC as the sole manufacturer of critical AI processors. Broad market sentiment remains subdued, with the CNN Fear and Greed Index standing at 28 in fear territory. The lab records an AI ETF score of none/100 based strictly on fund structure durability. The single metric that will shift this judgment is the overall revenue loss driven by U.S. export policy. SMH remains an engineered, highly concentrated instrument built directly on global semiconductor dominance. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 3.3%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Top signal, SMH data blackout. No numbers, no trade. Which metric would most change your business thesis on SMH? Comment below. This isn't financial advice, just engineering-level analysis for education. Markets move fast. Past performance never guarantees future returns. Always run your own numbers before pulling the trigger. Subscribe so you don't miss Thursday's deep dive. We're tearing down Seagate. Back to the lab.